Most entrepreneurs start a business thinking about one thing: freedom. Freedom of time, freedom of income, freedom to build something that's their own. But here's the truth nobody talks about. Most businesses are not actually sellable. They depend too much on the founder. The financials are messy. The systems aren't built to scale, which means when the time comes to exit, there's nothing to sell. This episode of The Boss's Office is brought to you by Boss Mortgage, an independent mortgage lender headquartered right here in Bend, Oregon. We serve clients throughout Oregon, Idaho, Colorado, Washington, California, and Arizona, and Montana, helping people navigate the mortgage process with clear guidance and disciplined lending. NMLS 2547821, Equal Housing Lender. All right, let's get into today's conversation. Today's guest is Lance Brant, managing partner of Capstone Accounting. But Lance didn't buy a thriving accounting firm and simply grow it. He actually started the firm from scratch in 2003 with no money and no clients. For the first 3 years, the business didn't make any money. And that's the reality most entrepreneurs don't talk about. The early years are usually messy. They require belief, persistence, and sometimes a very patient spouse. In Lance's case, the running joke is that his wife was about ready to divorce him until that first dividend check showed up 3 years later. After that, the marriage suddenly looked a lot better. Fast forward to today, Capstone has grown into one of the fastest growing CPA firms on the West Coast, with offices across multiple Western states and a team that continues to expand. Recently, Lance completed a transaction selling a large stake of the business to a private equity firm, positioning the company for its next stage of growth. He's also a very successful real estate investor, owning multiple rental properties, apartment complexes, and multi-family investments across several markets. But for me personally, Lance is also one of my closest friends. He's someone who believed in me early when I was starting Boss Mortgage, probably before I ever fully believed in myself. We also joke that he's kind of like my big brother in business. So today I wanted to bring him on the show and talk about something entrepreneurs don't think about enough. How do you build a company that someone would actually want to buy? Lance, welcome to Boss's Office.
Well, I'm so excited to be here. Randy's done a great job over the years, and you're growing your company like I grew mine.
It's fun. It's fun to watch, right? You're just kind of watching it 20 years later. We started in 2023.
Yeah, it's 20 years later, but you guys are doing even better than we are. But I did. Yeah.
Thanks. So you started Capstone in 2003 with no money, no clients, and for the first 3 years, the business didn't make any money. So take us back to those early days. What did the business actually look like, and what kept you going when things were not working yet?
I think it's the passion of actually serving clients. So you have to have a dream that your goal is to get to a point in time or a point in place where you're all about serving clients. And those first 3 years, it was tough because your expenses are high, your revenues are low. But you just have to have that vision and that drive to make it through those first couple of years. Because most first couple of years of a business, you really don't have enough money to live off of. You basically have enough. You're expanding and growing takes a lot of capital.
Yeah, it does. What moment did you realize, okay, this thing might actually work?
Well, you kind of hinted on it. My wife, took back those divorce papers, but it was actually really 3 years. After 3 years, I actually did get a dividend check, and that was so nice to actually be able to get paid by your business and actually feel like you didn't need to put the money back in. It was actually a freeing sense of acknowledgement. And then also, the clients just kept coming. I mean, we didn't even have to market. Once we got to our third year, we really didn't market that much because the businesses just kept coming in because we were doing good service.
What's that like? I can't wait till I get to that point.
You'll get there. What happens is you build a company that actually allows you to be recognized in the community as the leader. Mm-hmm. And I think you are the leader in mortgages, Randy. I think you're the best. I've used you. You're the best in the industry. So once you get that routine, people spread the rumor or the message. It's not a rumor, it's a message that, hey, this guy knows what he's talking about, and he's out there just to help you.
Well, this podcast is not meant to be self-serving, although I do appreciate the compliment. Yeah. But let's kind of get into the meat and potatoes of the podcast. Let's explain what EBITDA means. And I know you talk about EBITDA all the time. It's earnings before interest, taxes, depreciation, and amortization. So us entrepreneurs, we hear about EBITDA all the time. Can you explain it in simple terms, what it means and why it matters so much when a business is being valued?
Yeah. So when a buyer looks at a company, what they really want to do is look at the operating cash flow. And the operating cash flow really is defined by EBITDA. But what it means is people collect revenues for what they do, and then they have expenses, payroll, rent, whatever, and you deduct those expenses from revenues, and you come to like an operating income cash flow margin. And EBITDA is really just trying to determine what does this company actually produce in cash flow for a prospective buyer.
What's a good EBITDA to be at as far as percentage goes? I know you've talked to me before, because I've got an exit strategy for my business, as any entrepreneur really should have. And we'll talk about exit strategy later. But there's really something where you get to that percentage where you finally start becoming attractive to buyers.
Yeah, it's a really good question. And really think about it. If you were investing $100 into a company, what would you want to get in return? And typically that's 10 to 20%. So every industry is a little bit different. Like heavy manufacturing might be 10%, but a service business might be 15% to 20% profit on the bottom line.
So, if people say that the company said it sold for 6x or 8x EBITDA, what does that mean? Is that 6% or 8% on top of the bottom line?
No, it's usually a multiple. So like say, for example, after all your revenues and expenses are taken into account and you have a net income margin of $1 million, a company might come in and buy you at 6 times that cash flow. So you might sell that business for $6 million.
When you've got $1 million in cash flow.
Yes. Because the private equity market is really hot right now, and people want to get returns on their investments. And so if you're getting a 6 times multiple, that's a 16% return on your investment. So people would rather get a 16% return on that cash business versus just getting 8 or 10 in the stock market.
And the stock market, as we know, today's Friday the 13th, March 13th, 2026, hasn't exactly had a winning last couple of weeks, has it?
It's the stock market goes up and down a lot. Mm-hmm.
Yeah. This is actually one of those times where I'm thankful I don't have a whole lot of exposure. So what are some of the biggest mistakes entrepreneurs make when they try to sell their company?
Typically, they don't understand what the buyer wants. Buyers want something that's going to cash flow when the owner's not there. You kind of already mentioned it earlier. The company's got to be able to operate without a personal goodwill. It has to have entity goodwill, which means the brand or the company has to operate without the founder. You have to have actual infrastructure. Like if you sell a company and there's no accounting being done or payroll being done, or there's not an infrastructure and it's a very, one person's doing 6 tasks, that could be a downer. So people think just because my company's profitable that a buyer will want it. When they get into due diligence, which we'll talk about later probably, they want a company that actually they can buy and operates day one like it's been operating in the past.
So what you're saying is I need to get to the point to where my company is making money without me.
Yes, and that's kind of even like when I'm here in this interview, I have 18 people working behind me, and I'm making money just sitting in this chair.
I notice I notice you've got a new hat. Can you look at?
Yeah, look at that.
What does that say? How much are you billing me for this conversation? I saw that hat online. I was definitely a victim of meta advertising. I saw that and I said, "This is absolutely Lance." So hopefully we'll be seeing you on the golf courses with that. Yeah. So walk us through the moment, when private equity firms started showing interest. What did that process look like?
Well, luckily in our industry, they are looking at professional services companies as far as these are lawyers, CPAs, financial advising firms. The private equity world is really hot on those markets right now. Right. So we were actually getting calls every other week, every other month, but we were at a certain size. So we weren't a small company, but they were looking for companies with 25 to 50 to 100 employees, and they were looking to see if they could buy those markets. So when we got contacted, we were overcrowded with calls, mail slides and stuff, but we actually hired a broker. In our private equity world, we actually think we did the right thing. We actually hired an advisor and we went out to bid, and we went out to bid to 11 private equity firms before we sold.
Wow. So you had touched on something a couple of minutes ago about due diligence. So people, they hear about these private equity deals, but they don't really hear about due diligence. What surprised you most about that process? And can you explain a little bit about what that due diligence process looks like?
Well, I explain it in a medical term. Have you ever had a colonoscopy? Well, this is worse. It's a very deep dive into everything you have in your business. They talk about everything you do in finance, everything you have legally. They talk to your employees. They talk to everything in your business. They want to know where you get your mail at your business. They want to know where your copier lease is. It is a significant colonoscopy. Let's put it that way. They want to know everything about your business. So I would say our due diligence on our private equity firms took 14 months.
So are they doing forensic accounting, which it kind of seems redundant, right, for an accounting firm, CPAs, but they're doing what, forensic accounting? Yeah. They're looking at all of the different real estate that you own, every office. Are they looking into every employee? Like what? I mean, they're really, really doing the deep dive. They're
doing a deep dive. They're looking into everything we do. It was pretty amazing. There was so much stuff that I couldn't even believe, but they would send you a list of 400 questions and 400 requests. You'd get that request done, and then you would do another 400 questions would come from the lawyers. So there was a lot of stuff going on.
So, what actually, so talk to us about what changes. Let's fast forward through the 14-month due diligence process. What actually changes when a private equity firm becomes your partner?
I think the biggest thing you realize is they want you to be a little bit more professional. The financial reporting requirements are significant. In the past you could say, hey, I'm not going to get my finances done for a couple months, but we have timelines, deadlines. They actually have a lot of performance measures. They actually have a lot of
doing like a lot of KPIs.
Yeah, a lot of KPIs. We have to report KPIs, collections, different gross margin stuff. It's a lot of KPIs, but they also kind of want to know how the employees are doing. So they're really interested in employee turnover, employee satisfaction. So I was amazed about how much stuff they actually did care about our employees. And
so really the company culture.
Yeah,
right.
Exactly.
Because they want to make sure that people aren't, as soon as there's the transition of power, because so as managing partner and for what, 22, 23 years before this went through, what was it like handing over the reins to a new CEO that was elected?
It's very difficult. We call it the founder complex. But yeah, you think you can do everything better than the new CEO, but you really do have to delegate. A lot of that delegation is due to the fact that, yes, you've grown the firm up to a certain status of 150 employees or 200, but to get to the next stage, you really do need to have admin and infrastructure. And actually, it was probably better to hire a CEO to take over the managing partner's role, because those people are focused most on the business all the time, where I was mostly focused on the clients.
We've heard it said so many times, who got you here isn't necessarily who's going to take you there.
Yeah, you're exactly right.
So this is not on the list of questions, but that must have been a test for the ego.
Yes, it's
right. As a founder, it's got to be a test for the ego.
Well, and honestly, to tell you the truth, a lot of the employees were nervous because they've actually had very good success with you being the CEO and managing partner, and they just want to make sure that it continues that way. And we're still in it. We've only been in the PE process for 2 years, but it's been going very well. But still, to today, I mean, they're used to what I used to do for 23 years, but the CEO that's doing it now is doing a very good job.
That's awesome.
Yeah.
So you've also built a lot of wealth through real estate investing. Why do you believe real estate is such an important wealth builder for entrepreneurs? Why is it so important that if you're a business that has a brick and mortar, that you own your own real estate and invest in real estate?
Yeah. So there's three reasons really. Your third biggest expense typically in a business is rent, and so why would you pay rent to another person? Hopefully you're going to be an owner occupied space down the road, and especially in the service industry, you really want to be owner occupied. Why pay someone else rent? Pay yourself rent. The other thing is real estate is inflation protected. Really, we're printing about 8% money per year, so I think cash is losing about 8% value. So real estate and stocks are usually going up by 8% a year, not 3%, in my book. And then the third thing is the tax benefits for depreciation on buildings and stuff really can offset a lot of income. So, hey, I'm a strong believer in real estate.
I can't wait to have you on for another episode. Nerd Day with a CPA. That should be fun. We've done that before years ago. So for the entrepreneurs listening right now, what are 3 things they should start doing today if they want to build a company someone would actually want to buy someday? I'm asking for a friend, clearly.
Yeah. I think the first thing they should do is they should pick a career that actually they love to do and they want to help clients, because you can do a career and if you don't love it, it's going to show to your clients. So if you're not good at it, it's going to show. The second is get a good mentor. I think Randy's got a good mentor. I think it's real. I had mentors in my past that helped me see how I could grow my CPA firm and stuff like that. So get someone that can help you. And the third is, you know what? If you want to be an entrepreneur, you got to take the chance. I mean, being a W-2 employee is good, but there is a chance that you could be incredibly wealthy when you're 50 or 60 if you went and started your own firm.
Okay. I love that. All right. So when you bought the company in 2003, when you started the company in 2003, how scared were you?
I was really scared. I didn't even know. I mean, I was working on credit cards. I did not know how I was going to pay my mortgage every other month.
That's you know what, I can empathize with you on that one.
Mm-hmm.
All right. So let's say someone gets a late start in their 30s or 40s, right? So I was 43 when I started this company. If you are, somewhat late to the game, and 43 to many people would be very young. I mean, when you think about it, right? So if you started 20 years ago, you would have been what,
33, 36.
33, 36, yeah, right?
Yeah.
So maybe someone who's getting a late start, do you have any tips as far as, how to ramp things up, quickly?
I actually don't think 30s or 40s are late. I mean, we got to really understand that we're probably going to live into our 80s or 90s. Don't think you got to retire at 55, 60, or 65. What I see is a lot of people that start in their 40s have a very good expertise, or they actually know what they're doing in their job. So if they're technically strong, that's a good thing to be at. So I don't think being in their late 40s is a big deal, but I usually think if you're in your 40s, you're probably a technical expert. So you should be able to grow your business a little even better.
A lot of really good stuff, Lance. Thanks for answering the barrage of questions. I even learned quite a bit about EBITDA, and I'm sure some of our listeners will as well. And a couple things to wrap up today's episode. I want to talk about the book of the week. This week's book is Rocket Fuel by Gino Wickman. And it's about one of the most important relationships inside a successful company, the visionary and the integrator. The visionary drives ideas and growth, while the integrator builds the systems that essentially and actually make the company run. And when those two roles are aligned, companies scale fast. Now, some people, and I don't know if you've read this book, this is a phenomenal book, by the way. This helped my integrator, Rocky, the president of my company. It helped us understand more and build the company, not necessarily faster. I would say more methodical, more, things thought through. Did you play both roles, or did you have an integrator?
I played both roles for when we were, the first 5 years, because we couldn't afford anything else.
Mm-hmm.
But no, I've had some really good operators that took over the operations. In fact, that's one of the things you have to have. You have to give up operations to another person.
Makes it a lot easier. Well, this week's hard lesson, one thing every entrepreneur learns eventually is business comes in seasons. There are seasons where everything is clicking, and then there are seasons where you feel like you're stuck in the mud. Deals fall apart, stress builds, momentum slows. When you're in that moment, it can feel permanent. But if you've been doing this long enough, you know something important. Storms pass. You've solved the hard problems before. Lean on that experience, because most of the time, there is sunshine on the other side. In this week's tactical takeaway, one of the most powerful accelerators in business, and Lance already touched on this, is mentorship, right? It's learning from people who came before you. Mentors, they shorten the timeline. They've already made the mistakes. Lance, you've been one of the great mentors in my life. And even, 5-6 years before even starting this company, it completely changed how I look at money. It's like, well, hey, look at this big W-2 I made, versus it's not so much about the W-2 or what's on the bottom line. It's the freedom that you get, right? You can make a 7-figure W-2. I imagine you're probably going to have a pretty high tax liability on that.
Yes, you would. Yeah.
sometimes the right conversation at the right time can change the trajectory of your career. So find those people, ask questions, and listen closely. Next week, we're going to have Matt Robinson on the show from the agency. Thank you again, Lance Brant, managing partner with Capstone Accounting, for joining us on the Boss's Office, where it's lonely at the top.
Thank you so much.